I'm Krishna and welcome to Who Said What. In this show, I dive into interesting comments made by notable figures from across the world, whether it's finance or the broader business world, and dig into the stories behind them. Today, I'll go over the comments from Aswath Damodaran, Neelkanth Mishra, and two other people. By the way, I saw a bunch of comments from you asking for all the links and sources to this. We publish this as a newsletter as well. You'll find all the links there. I'll link the newsletter in the description below. With that out of the way, let me get started. Aswath Damodaran recently wrote a blog post focused on globalization. Now, this is a term often used by people on Twitter and in newspapers and on TV channels. See, I used to think of it as a fancy word that many smart people throw around. Now, since he wrote about this topic, I became a little more curious to learn about what globalization actually means. Now, before sharing what he said, let me briefly explain globalization first. See, we all live in a globalized world, though we may not fully realize it. You're watching this video or reading this newsletter on a device likely made by a US company built with components from China, possibly assembled in another country and shipped to you through international waters. Now that's essentially what globalization is. It is how countries, businesses, and people around the world become more connected. It means products, ideas, money, and even cultures move across borders more easily. And there's a really long history to this. Let me just quickly summarize the events for you. See, one of the earliest forms of globalization was the Silk Road, a trade route connecting China to Middle East and Europe, which allowed goods, ideas, and even religions to spread. Later, during the Age of Exploration, European powers like Spain and Portugal started exploring the world, leading to colonization and creation of global trade networks. Then comes the Industrial Revolution, which accelerated globalization by making mass production possible, which led to an explosion in international trade. But the form of globalization we see today really took off after World War II. The world saw the damage caused by economic isolationism during the Great Depression and wanted to prevent another global conflict. This led to the creation of organizations like the IMF, the World Bank, and later WTO, which promoted open markets and free trade. The fall of Soviet Union in 1991 was another turning point. Western countries believed that capitalism and free markets had won, and globalization was seen as the inevitable future. Now everything was going good from that point till 2008. Then everything fell apart, all because of the 2008 crisis. Before the crisis, globalization was seen as a force that would bring prosperity to everyone. But when markets crashed, millions of ordinary people lost their jobs, while banks and large corporations were bailed out. Now, this made many people skeptical of globalization, seeing it as a system that benefits the rich while leaving the poor behind. Then, during the COVID-19 pandemic, further exposed the risks of globalization. The pandemic showed how fragile global supply chains are. When factories shut down in China, the whole wide world felt the impact. Now coming to what Aswath Damodaran has said, globalization has been a net plus for the global economy. But one reason it is in retreat is because of a refusal on the part of its advocates to acknowledge its cost and dismissal of opposition to any aspect of globalization as nativist and ignorant. He's basically saying that globalization has been beneficial overall, but the people who pushed for it often ignored its negative effects. When regular people complained about losing jobs to outsourcing, policymakers brushed them off as anti-progress or ignorant, instead of addressing these concerns. Globalization's biggest advocates acted as if it was inevitable, which led to major backlash. Now this is kind of on similar lines with what Danny Roderick, a Harvard economist, had said. He argues nations cannot simultaneously maintain all three of the following: national sovereignty, economic globalization, democratic politics. According to Roderick, countries can only choose two out of these three options. See, if a country wants both democracy and national sovereignty, it must limit economic globalization. If a country wants both economic globalization and democracy, it must give up some national sovereignty in favor of international governance. Third, if a country wants both economic globalization and national sovereignty, it must limit democratic politics, essentially becoming more authoritarian. Now coming back to what Damodaran said, he also points out how China is the biggest winner from globalization. He says the biggest winner from globalization has been China, which has seen its economic and political power surge over the last 4 decades. China took advantage of globalization by making itself the world's manufacturing hub. Western companies moved their factories there because labor was cheaper, and this helped China's economy grow at an incredible pace. But now, as the US and other countries rethink globalization, China's economic rise is facing new challenges. Now, if the image of Trump popped into your head right now, you're getting the drift. Another big insight from Damodaran is about how globalization affects democracy. He says, in my view, globalization has weakened the power of democracy across the world. The fall of Iron Curtain was greeted by optimists claiming the triumph of democracy over authoritarianism. But the biggest winners from globalization were not paragons of free expression and choice. Now, this is a controversial but important point. People used to believe that globalization would spread democracy. As countries opened up to trade, they would also embrace democratic values. But the opposite of that has happened. China, an authoritarian country, became the biggest economic winner from globalization, while many democratic countries struggled. Meanwhile, in the West, people started to feel like their votes didn't matter. Global trade deals were being signed without public input, and big corporations had influence over government policies than regular citizens. After reading Damodaran's view, I realized there is no single right or wrong answer about globalization. It's both good and bad depending on how you look at it. That's where an Aeon article by Anthea Roberts and Nicholas Lamb comes in. In this article, which is based on their book Six Faces of Globalization, argues that globalization is widely debated, but the problem is that most people view it through a single narrow lens. It introduces six main narratives, different stories people tell to explain globalization, but says all of them are flawed because they each capture only part of the truth. Instead of picking right view, the author suggests a more flexible, fox-like approach that considers multiple perspectives. They outline six different narratives that people use to explain globalization. The first one, establishment narrative. This is the classic economic view that globalization helps everyone by increasing trade, boosting economies, and reducing poverty. It argues that when countries specialize in what they do best, the whole world benefits. But here's the flaw. It ignores inequality. Yes, the world gets richer, but not everyone wins equally. Some people, industries, and even whole countries get left behind. Second, the left-wing populist narrative. This view says globalization helps only the rich, big corporations and billionaires while making life worse for regular workers. Factories move overseas, wages stagnate, and middle class shrinks. Now, this perspective overlooks how globalization has lifted millions out of poverty in developing countries. While inequality has worsened in some places, overall economic conditions have improved for many. Third, the corporate power narrative. According to this view, globalization is game rigged in favor of multinational corporations. These companies make use of cheap labor, shift profits to tax havens, and influence government policies to serve their interests. Now, this perspective simplifies the problem. While corporate influence is real, not all businesses exploit globalization in the same way, and some regulations have kept corporate power in check. Fourth, the right-wing populist narrative. Now, this perspective argues that globalization has hurt the local working class by allowing jobs to be outsourced and opening borders to immigration. It often emphasizes national identity and sees globalization as a threat to cultural traditions. Now, here's the flaw. It often ignores economic realities. Immigration and trade can also create jobs and economic opportunities. Blaming foreigners doesn't solve the deeper structural issues in economies. Fifth, the geo-economic narrative. Now, this view sees globalization as a geopolitical struggle, especially between US and China. Economic policies aren't just about trade, they're about power, security, and influence. Now, the flaw is it turns economic cooperation into zero-sum game, assuming that one country's gain is always another one's loss. This mindset can lead to trade wars and policies that hurt everyone. Now, the last perspective, the global threats narrative. This perspective sees globalization as a driver of global crises, pandemics, climate change, financial instability. The argument is interconnectedness has made the world more fragile. Now, the flaw is while globalization does spread risks, it also spreads solutions. International cooperation has helped tackle issues like disease outbreaks and technological advancements. Now, there's still a lot more for me to learn on this topic, but what I've learned till now about this is that there's no simple answer to whether globalization is bad, dead, or changed. It has winners and losers, advantages and risks. And as Aswath highlighted, The world will prevail. If a trade war plays out, it will be very different than the one that existed before globalization took off. Now on to the second comment. See, since the start of 2025, a bunch of things have happened around the world and in India. Trump coming in, Europe being in trouble, our economy seems to be slowing down, small and mid caps falling, and so many more things. Coincidentally, Neelkanth Mishra, the chief economist at Axis Bank, recently spoke about all of this and a few more important things. Now, many of you might already know who he is, but for those who don't, he's probably one of the best economic thinkers of our time. He first made an interesting observation about Donald Trump.
कभी कभार हिस्ट्री ऐसे आदमी को खोज निकालती है जिसका काम ही विध्वंस करना है, डिस्ट्रक्शन करना है। तो ट्रम्प शायद ये ना सोचते हों कि उनका काम वो डिस्ट्रॉयर वाला है, लेकिन हिस्ट्री में ऐसे लोग आए हैं कि अगर कोई सिस्टम काम नहीं कर रहा है तो उसको तोड़ दो। अब उसके ऊपर क्या बनेगा ये पता नहीं।
What he means here is clear. If we look back historically, disruptive figures like Mao during China's Cultural Revolution upended established system, causing short-term chaos but eventually making way for transformative changes. Henry Kissinger, who famously described Trump as a disruptor, suggesting history occasionally requires chaos to reset stagnating systems. However, Mishra also warns that such disruption breeds uncertainty, especially in global markets, making investors hesitant to commit capital, leading to slower global growth. Shifting his focus to India, he strongly pointed out this.
तो हमारी अर्थव्यवस्था में जो अभी थोड़ी गिरावट आई है, जो कह लें कि हम स्पीड स्लो हो गया है, वो सब कुछ सेल्फ इन्फ्लिक्टेड है, सेल्फ ड्रिवन है। जितनी जल्दी हम उससे बाहर निकलें, उतनी तेजी से इकोनॉमी भागेगी।
To deeply understand his point, let's expand a little further. See, India's recent slowdown is tied closely to regulatory policies, liquidity management, and challenges in critical sectors. By slowdown, here's what he means. Our GDP, which was initially predicted at 7%, is now revised down to 6.6% for FY24 to 25. Overall, the unemployment rates have been going up, and the persistent inflation. He highlights the severity of RBI's excessively cautious approach, especially regarding liquidity. For example, he specifically points out how RBI's aggressive interventions, such as keeping interest rates high and artificially stabilizing the rupee, created uncertainty and contributed to the economic slowdown. He believes that India can comfortably achieve growth rates of 6.5 to 7% by proactively addressing these internal policy missteps. He also discusses the negative impact of tight regulations that make businesses hesitant to invest, describing the current regulatory environment as one where internal policing has overshadowed economic vibrancy. Neelkanth Mishra underscores that genuine economic recovery depends significantly on improving liquidity conditions and encouraging private investments through clearer business-friendly regulations. This is along the same lines of what V. Ananta Nageshwaran, Chief Economic Advisor, had said in the recent economic survey. That too right in the beginning. He said something like, lowering the cost of business through deregulation will make a significant contribution to accelerating economic growth and employment amidst unprecedented global challenges. Expanding on the regulatory missteps, Neelkanth specifically criticized RBI's recent currency policy.
एक और शायद भूल हुई थी आरबीआई से कि उन्होंने करेंसी को ऑलमोस्ट फिक्स्ड कर दिया था। बट जैसे ही लोगों को लगने लगा सितंबर अक्टूबर के आसपास कि शायद रुपया हिलेगा, तो एक्सपोर्टर्स ने हाथ खींच लिया। बेसिकली कहा कि भाई जो 30-60 दिन जो भी उनको लीवे होता है कि जो वो डॉलर रख सकते हैं, उसके बाद उनको मैंडेटरी जाना पड़ता है। तो जो ऐसा हुआ तो उन्होंने खींच लिया, तो डॉलर की सप्लाई खत्म हो गई। उसी समय में जो इंपोर्टर हैं उन्होंने कहा कि अरे यार तो हेज करना पड़ेगा, तो हेज करने का डिमांड आ गया, तो डॉलर की डिमांड बढ़ गई,
फिर बढ़ गई।
इसीलिए आरबीआई को $60 बिलियन से इंटरवीन करना पड़ा। अच्छा, उसी समय में वो $15-20 बिलियन एफपीआई भी ले जा रहे थे, तो
बिल्कुल
समस्या। अब $60 बिलियन से आप इंटरवीन करेंगे। अच्छा, मैंने इतना सब इसलिए समय लगाया इसको समझाने में कि ये एक वन ऑफ एडजस्टमेंट था।
In essence, he's saying RBI's attempt to maintain a stable rupee unintentionally triggered sharp volatility, forcing a massive $60 billion currency intervention. Arvind Subramaniam, alongside economists Josh Fellman and Abhishek Anand, similarly highlighted this issue. They suggested that RBI's unofficial peg to the dollar artificially strengthened the rupee, hurting exports, incentivizing excessive foreign borrowing, and eventually causing severe market volatility. Now, RBI's intention, while intended to maintain stability, often hide underlying economic realities, creating abrupt shocks when corrections inevitably occur. On fiscal deficit management, he offered critical insight.
सरकार का वित्तीय घाटा किसी वर्ष में गिरता है तो एग्रीगेट डिमांड पे उसका नेगेटिव इम्पैक्ट आता है।
अच्छा।
तो अगर 4.8% का 4.4% हो रहा है, कहने का मतलब सरकार जो है वो 0.4% ऑफ जीडीपी से कम सपोर्ट कर रही है।
ठीक है, ठीक है।
Here, he cautions that when governments cut spending to manage deficits, overall consumer demand inevitably declines. The former RBI governor Raghuram Rajan had stated in his paper titled The Fight Against Inflation, a measure of our institutional development, he said that aggressive fiscal tightening during periods of economic slowdown can actually worsen economic conditions, deepening recessions instead of cutting it off. Neelkanth Mishra similarly suggests that recent tax cuts alone cannot significantly boost consumption if the broader consumer confidence and purchasing power remain weak. He also further discussed stock market valuations, particularly small and mid caps.
Demand for equities is now less than supply of equities.
Okay, nice.
तो सप्लाई डिमांड से ज़्यादा है। और ये भी मार्केट मैच्योरिटी का एक बड़ा अच्छा साइन है
जी।
लेकिन सप्लाई बढ़ने के कारण पी मल्टीपल जो है वो जो जिस तेजी से भाग रही थी वो नहीं भागेंगी और करेक्शन आएगा। तो जब तक लीडिंग इंडिकेटर्स ये ना बताने लगे कि अब इकोनॉमी वापस 6.5-7 की तरफ बढ़ रही है, तब तक मेरे ख्याल से पी मल्टीपल्स तो नहीं बढ़ेंगे। मिड कैप स्मॉल कैप्स में मुझे तो लगता है अभी भी
दर्द है,
कैपिटलेशन नहीं हुआ।
Now, increased supply through IPOs and new listings has diluted the demand, causing valuations to stagnate or decline. This somewhat echoes warnings from ICICI's Shankaran Narain, who also highlighted the elevated risks in mid-cap valuations, advising investors to carefully reconsider their positions. I had covered this in one of our previous episodes. Mishra and Narain collectively indicate investors to temper expectations and exercise caution with small and mid-cap investments given the inherent volatility and valuation risks. He also touched upon the complex relationship between India and China. He is essentially advocating for practicality.
उनके कैपिटल से, उनकी टेक्नोलॉजी से, उनके इन्वेस्टमेंट से हमें फ़ायदा हो सकता है।
क्यों नहीं?
हमारे मार्केट से उनको फ़ायदा हो सकता है। तो इसमें हमें ये देखना है कि हम कैसे बिना किसी जियोपॉलिटिकल कॉम्प्रोमाइज के
India can benefit economically from Chinese capital and technology but must remain vigilant regarding national security. He is advocating a careful economic approach here. Historically, India's economic ties with China have been complicated. While political tensions persist, China remains India's largest trading partner with bilateral trade surpassing $100 billion annually. He is suggesting that India should proactively engage Chinese investments and technological cooperation in areas like electronics, EVs, and consumer goods manufacturing, which can boost job creation and economic growth significantly. Last week, I had covered a talk that Neelkanth Mishra gave at an event. Here are a few additional things that he shared there that add more context and depth to what we have discussed here. One critical observation Mishra made was about the increasingly fragmented global trade landscape. He highlighted how tariff headlines capture our daily attention, yet emphasized that tariffs are merely a very small part of the broader industrial policy toolkit. Countries around the globe are increasingly using export subsidies, targeted tax credit, foreign investment incentives, and subtle regulatory barriers, such as India's recent reliance on quality control orders, to indirectly limit imports. He sees this as just the start of a very turbulent phase, marking a fundamental shift away from global multilateral cooperation toward more localized and less efficient bilateral arrangements. Another particularly insightful point Mishra raised was about the structural nature of China's dominance. See, China isn't just a large manufacturer. Neelkanth Mishra pointed out that it controls 60 to 90% of global capacity in crucial high-growth industries like solar panels, energy storage, and electric vehicles. This structural dominance creates deeper tensions that simple tariffs alone can't resolve. He warns this situation could provoke increasingly unconventional policy responses globally. Building further on this theme, Neelkanth Mishra made a fascinating prediction about currencies becoming the next frontier of trade conflict escalation. He drew historical parallels to the 1930s when countries turned aggressively to currency devaluation after tariffs failed. Mishra noted how Trump's recent seemingly desperate ideas like exploring strategic crypto reserves stem from the currency dilemma. The harder he works with higher tariffs, the more the dollar appreciates, so he has to find a way to devalue it. He also pointed to vulnerabilities in China's currency situation, noting how $1.4 trillion has exited China over the last decade, and low Chinese interest rates make further currency depreciation an easy policy lever for Beijing. He also underscored some critical but less visible risks emerging from current US policies. He cautioned about America's persistently high deficits at a time of historically low unemployment and unusual pro-cyclical fiscal policy, leaving no room for maneuver in tougher economic times. He likened this to an asteroid strike, unpredictable in timing but potentially devastating in impact. Moreover, he highlighted the sharp reduction in US immigration, reportedly down by 87%, as quietly undermining America's long-term growth prospects, given how dependent recent economic expansions were on immigrant labor. On India's domestic economic front, he strongly pushed back against claims of structural slowdown. Instead, he attributed India's current economic weakness to specific cyclical policy actions. Notably, he highlighted unintended fiscal tightening, overly prescriptive regulatory constraints now being more relaxed, and monetary missteps by RBI, particularly directives causing banks to reduce loan deposit ratios, inadvertently creating a negative credit growth spiral. Mishra argues emphatically that restoring liquidity conditions is crucial as interest rate cuts remain completely ineffective until liquidity recovers to healthy levels. Lastly, he illuminated India's hidden growth catalyst, the revival of real estate. Contrary to popular narratives around sluggish private sector investment, he emphasized that the most significant contributor to India's investment decline since 2012 wasn't factories or machinery, but reduced household investment in housing. He explained that as the real estate sector rebounds with increasing launches and sales already visible in major cities, it would set off beneficial downstream effects in steel, cement, and manufacturing, fueling broader economic revival. Now, there are a lot more interesting things that he shared that I haven't covered here. It's definitely worth listening to what he was talking about in that conversation. You'll find the link in the newsletter below. So there are a bunch of times where we have discussed critical or rare earth metals on the daily brief, and considering it links to China, we all tend to get a little obsessed with the topic. Recently, Pranay Kotastane of Takshashila Institution spoke about this in his Hindi podcast Pulyabazi. It's probably one of the most insightful conversations I've heard this week. The podcast covered so many aspects of critical minerals debate that I felt a bit disappointed when it ended after an hour. Regardless, it taught me quite a bit and I wanted to share some of those insights here. What initially intrigued me to listen to the podcast was Pranay's remark, critical minerals are not like oil. Now, before I get started with what all he said, let me set up some context by explaining what critical minerals are. See, critical minerals are metals and minerals vital for various modern technologies, including smartphones, electric vehicles, wind turbines, military equipment, and even specialized industrial applications. But their importance goes beyond mere industrial use. It's deeply tied to geopolitical dynamics and global supply chain vulnerabilities. In the podcast, Pranay explains the fundamental difference clearly.
ऑयल और क्रिटिकल मिनरल्स में बहुत फर्क है। एक तो ईंधन की तरह प्रयोग करते हैं आप, और दूसरा क्रिटिकल मिनरल्स ईंधन की तरह प्रयोग नहीं करते। तो ईंधन को तो आप जला देते हैं, उसको वापस एक्सट्रैक्ट नहीं कर सकते। एक बार आपने पेट्रोल जला दिया, आप उसका वापस रिटेन नहीं कर सकते। लेकिन क्रिटिकल मिनरल्स को आप रिसाइकल कर सकते हैं। आपका फोन, आपका लैपटॉप से हम क्रिटिकल मिनरल्स को अक्सर रिसाइकल किया जा सकता है। अगर किसी भी देश ने ऑयल एम्बार्गो किया तो इकोनॉमी वाइड इन्फ्लेशन होगा। आपने एक बार फोन खरीद लिया तो ऐसा नहीं है कि अगले सेकंड वो उसकी क्वांटिटी कम हो जाने वाली है क्रिटिकल मिनरल्स की।
कंज्यूमेबल नहीं है वो बेसिकली।
This means, unlike oil, critical minerals don't vanish after single use. They are recyclable, recoverable, and reusable. A misconception Pranay clarifies is around rarity.
एक तो रेयर अर्थ रेयर नहीं होते, रेयर अर्थ कई जगहों पर होते हैं.
The real challenge isn't geological scarcity, but rather extraction, refining, and processing, which China dominates comprehensively. China's control over critical mineral supply chain is multidimensional. It extends beyond just geological resources to include substantial dominance in refining and processing capacities. China controls approximately 90% of global refining and processing for rare earth minerals, despite other nations possessing substantial reserves. Pranay emphasizes how China has strategically leveraged its refining capacity, with global minerals being transported to China for processing before returning to international market. This extensive control can be traced back to geopolitical decisions made by Western countries decades ago. Pranay explains Western nations effectively outsourced the environmentally damaging aspects of mineral processing to China. They viewed these activities as economically unattractive and environmentally problematic. China in turn sees this as a strategic economic opportunity, developing significant expertise and capacity over decades. This aligns closely with insights from Javier Blas, a Bloomberg columnist and author who focuses on energy and commodities. In his piece, he talks about how a handful of metals that many refer to as critical minerals, but that he prefers to call minor metals. There's one more particular line where he notes how the term critical minerals can be great for companies' image, or a lot sexier as he puts it, especially when firms want to boost their share prices. By branding them as critical, there's an aura of urgency and importance that can be appealing to investors, even though the overall market size of these metals is relatively small. Blas has pointed out that although China has leveraged its position strategically, the total economic scale involved isn't typically large enough to disrupt global economies severely. Yet, the geopolitical implications shouldn't be underestimated, as demonstrated when China halted rare earth exports to Japan in 2010 over territorial dispute, profoundly shifting global supply chain dynamics. Pranay highlights this incident as a significant turning point, leading many nations to reassess their dependence on China and develop alternative strategies. Pranay also offers realistic perspective on India's position in this scenario. He discusses India's considerable but underutilized mineral resources, pointing out bureaucratic hurdles, environmental concerns, and infrastructure inadequacies as major roadblocks. A telling example he shares is India's lithium discovery in Risi, Jammu and Kashmir, where bureaucratic delays stalled any development.
वो जो रियासी वाली जो न्यूज आई थी कि एक
लिथियम है जो वहां पे,
वो अभी तक वो मिनरल ब्लॉक बिका भी नहीं है, पता है आपको?
हाँ,
आप सोचो 3 सालों में वो बिका ही नहीं है. कहाँ से माइनिंग प्रोडक्शन स्टार्ट होगा?
Given these hurdles, Pranay recommended India strategically focus on recycling and urban mining, areas less hindered by bureaucratic inefficiencies and capable of delivering quicker results. Finally, Pranay cautions against exaggerated fears about China's dominance. He argues that China, by imposing export controls and creating supply uncertainties, inadvertently incentivizes other nations to accelerate their efforts in finding alternatives and diversifying supply chains. This, he suggests, could ultimately undermine China's own leverage in the long term. I can't wait for their next episode on this and cover it here. Now for the final story, Jim Bianco from Bianco Research highlighted a troubling update from Federal Reserve, calling it a triple downgrade in a recent interview. He says they expected a weaker economy, higher inflation and greater uncertainty.
Downgrade economy, more uncertainty, yes, even higher inflation, but you downgraded the economy more than you raised inflation.
Despite this negative outlook, markets remain surprisingly calm about future interest rate cuts, showing only 23% chance of a cut in May.
The market is only putting a 23% probability of a Fed cut May 7th. A 77% chance they're going to hold.
Bianco points out a key disconnect. If there is no strong reason for a rate cut by May, there probably won't be any cuts through summer. The recent cycle of rate cuts, that is September, November and December, might already be over. He also notices a shift in President Trump's focus. Trump isn't tweeting about the stock market anymore. He's tweeting about 10-year bond yield. This indicates Trump's priority has changed from boosting stocks to lowering borrowing costs, driven by an upcoming debt challenge that few people are talking about. Bianco explains why Trump is so concerned about bond yield. There is a huge amount of corporate debt that needs refinancing later in 2025. Back in 2020, companies borrowed a lot of money when interest rates were extremely low. Most of this debt is now coming due on 5-year terms. Refinancing at today's higher rates could mean companies have less money to invest and might have to cut jobs. The administration is trying to reduce this pain upfront, hoping to lower interest rates now so the economy can recover by 2026, right in time for midterm elections. He also outlines a simple framework for expected investment returns over the next several years. Cash, safe investments like money markets will yield around 4%, close to the current federal funds rate. Bonds should average around 5% returns, though individual years could vary depending on interest rates. Stocks, given current high valuation, stocks are expected to return about 6% annually, only slightly better than bonds.
Cash is going to return you 4%. Bonds, I think bonds are going to return 5%. Stocks, this is the tricky one. And the answer is about 1% over the bond market. So whatever the bond market's going to return you, about 1% more excess return is what they refer to it as. That's about 6-ish%, maybe 7% if you want to be a little bit more generous.
This lower return environment means investors should reset expectations compared to the exceptional returns of recent years. Bianco clarifies that Trump sees tariffs not as permanent revenue streams but as tools to correct economic imbalances. Even top financial leaders like Jamie Dimon have begun to agree that Trump's economic strategy could help the American middle class. Trump's goal, Bianco argues, is to shift focus away from the stock market and toward long-term growth by reducing bond yields, cutting inflation, increasing jobs, and controlling the deficit. Bianco provides clear numbers to show America's fiscal problems. The federal government's budget for the last 12 months ending February was $7.1 trillion, about 25% of the GDP. 1 year earlier, it was $6 trillion. 10 years ago, it was only $3.3 trillion, showing it has more than doubled in a decade.
The last 12 months ending in February, the federal government's rolling 12-month budget was $7.1 trillion, about 25% of GDP. 1 year ago, February of 2024, was $6 trillion. It's up $1.1 trillion in a year. 10 years ago, it was $3.3 trillion. It's more than doubled.
The current budget deficit, which is 6.5% of GDP, is the largest in peacetime history. Only major crises like COVID, the financial crisis, and major wars had higher deficits.
Time budget in the history of this country as a deficit, as a percent of GDP, 6.5%. The only times it's been larger, there's been 5 times in American history it's been larger than it is now. The COVID response, the worst part of the financial crisis, and just barely. That one was 7%, and this is 6.5%. World War II, World War I, and the Civil War. Those are the only times the budget deficit in the United States has been as big as it is right now.
This explains why the administration sees the situation as unsustainable and is pushing for significant changes. Bianco refers to Trump's economic strategy as Mar-a-Lago Accord, comparing it to historic economic shifts like the Bretton Woods Agreement or Plaza Accord.
A new president trying to completely realign the global trading system. You can't help but go down the route of politics because that's really what's driving all this. That is what the Mar-a-Lago Accord is all about. Where does the name come from? Every time there's been a major realignment of the trading system or the currency systems of the world, they name it after the resort or the hotel where it took place. A lot of people don't realize this, but the Bretton Woods Agreement, Bretton Woods is still a resort in New Hampshire to this day. And the Plaza Accord was named after the Plaza Hotel. So Mar-a-Lago Accord is kind of riffing off that idea. There isn't an accord. There isn't going to be a meeting where there's going to be some signature of something. It's where Trump lives. And Trump is the center of all of this. And that's why they call it the Mar-a-Lago Accord.
I spoke about this on the last week episode, but let me give you some context on what Mar-a-Lago Accord is. See, it is a speculative idea, not yet a formal agreement. The main goal is to weaken the US dollar to make American exports more competitive globally, addressing trade imbalances and boosting manufacturing. This could involve coordinated efforts with trading partners to adjust currency values, or other economic policies. Although there won't be a formal agreement signed, this represents Trump's plan to reshape global trade, currencies, and America's economy from his home base in Mar-a-Lago. The administration views current conditions, high debt deficits, and government spending as unsustainable and wants a significant reset of the global economic system. Bianco sees better investment opportunities in Europe rather than US because European markets are cheaper and were previously overlooked. He notes European stocks started rising significantly after global elites at Davos said Europe was in trouble, a classic sign of a turnaround. Specifically, Europe's concentrated markets, for example, 10 German stocks make 60% of the market, and increased government infrastructure spending could drive big gains. Regarding China, Bianco is cautious. Despite government support and aggressive actions like jailing critics and pumping money into the economy, China's market struggle due to too much hype, declining growth, and issues with transparency and rule of the law.
SAP is 16% of the German stock market. 10 stocks in Germany are over 60% of their stock market. And most of these are industrial electronics kind of companies. And so when you get this infrastructure spending thing, bam, those markets go. And they're cheap to begin with. So I think the European markets got more room, they got more legs to go with. The Chinese markets, the problem with the Chinese markets is they've been overhyped by hedge funds and the like for many years.
Bianco doesn't expect a financial crisis but predicts a period of adjustment. He thinks the stock market, which is the US market, could end roughly flat for the year, arguing it's difficult to get severe drops without a major shock. He compares today's situation to early Reagan years, initially tough but eventually showing improvement. Bianco advises policymakers to make necessary adjustments now to ensure economic recovery by mid-2026 or 27, potentially boosting political support by showing results. Overall, Bianco encourages investors to understand that markets don't exist in isolation. They are influenced by broader economic and political shifts. Adjustments happening now, even if challenging, might set the stage for stronger economic growth in the future. That's all for this episode. If you have any feedback for me, please let me know in the comments below. यार वो है ना थोड़ा सा वो ब्राइटनेस ऐसे आ रहा है ना तो मैं वो वर्ड नहीं पढ़ पा रहा. आप यहाँ आओ एक बार. अभी सही है. हाँ अभी सही है. Yeah, pause. Let's go.